Hey guys, I don't want to wait much longer. I'm glad you guys are on time. We'll just have to let those join us that come a little bit later. How did you meet Lynn? Did you do a
She was a
transaction?
listing agent on another client.
She was a listing agent and you were with working buyer. Awesome, awesome. So you guys, Josh and Lynn got to chatting and stuff, and it ended up working out to where he signed up for a date to come in and talk to us all. So it was kind of interesting when you were trying to come up with your topic and everything. It's like, this wasn't a formal presentation before, right? This is something like, this is what I need to talk about in the market today, and we'll put something together. So me and Ashley, I didn't introduce you to Ashley. Did you meet Ashley?
Yes.
Okay. Okay, cool. Okay, she's gonna jump on. Okay. And we're like, well, what's the title? What's the description? And we were going back and forth a little bit. But if any of you watched the little teaser thing we did on Zoom and did a little interview with him where he just kind of introduced himself, talked about it. Even Lynn said, well, this is intriguing me. Because this is a talking point. I mean, pay attention today, because this is something that you guys can actually purposely share with your clients, share with people, because they're thinking it. They're thinking, hey, I'm in this home, I've got this low interest rate, I want to move up, or I want to, get a different home or whatever, but I don't want to give up my 2.87 loan or whatever, 3s, 4s, because they're higher now. And so breaking that down and coming up with scenarios on, well, what are your options? We talked about this on Zoom. I love people to have options, and they can't make adequate decisions unless they know what their options are. Because if you say yes to something, you're saying no to everything else. So if you don't know what you're saying no to, you might make the wrong decision. So great talking point. Maybe I'd even suggest take the link to the Zoom, a little short, it was like 4 or 5 minutes, I think. Share that with your clients and stuff that might be thinking this, or they know somebody that does.
Where is this link?
It's on the registration page for the training, and it's in Team Limitless Facebook group. It's in our YouTube channel. So you can just grab that, because if they're not thinking of it, they know somebody else is. So Josh, come up here in front of here, and I'll turn this, like you said, maybe maybe not. Capture part of the screen. You can stand right there and introduce yourself a little bit. Thanks for coming. Glad to have you.
Well, dude, thanks, man. Now, just real quick tutorial. So which button advances, which button goes backwards?
So there.
So that's advanced. Okay, perfect. I might want to go backwards in a couple spots.
Okay, no worries.
All right, well, so as I get started, I guess I just wanted to start off with who's noticed the market's changed a little bit over the last year or 2 years.
Yeah.
Quite a bit different market, right?
In this beginning of this year.
Right, but also, who doesn't really care what the market's doing and still wants to make a great living and have a great time, right? And so that's ultimately what really matters, right? Is who cares what the market's doing? We got to go ahead and make a living. We got to do what we got to do. We got to help our clients out. But as the class is titled, we have a lot of clients or would-be clients who are kind of snagged with their rates. They got these pesky low interest rates and stuff like that, and so. I'm going to talk about that. Pesky low interest rates.
Such roadblocks.
You like that?
Yeah.
But before I get into that, I figured I'd start by introducing myself. I have been a mortgage loan officer and a lender. For those that would be confused watching this, like, who's this guy? So I'm a mortgage lender, mortgage loan officer. I have been for 20 years. Started in 03. A huge refi boom. They were pulling people in off the street. I didn't know what a mortgage was. It was fun jumping on the phone, but anyway, that's how I kind of got started. This is the first job I ever loved and truly do. I mean, I figured out people can be born for something. I don't know how to describe it. Anyway, so after 20 years of this, I've been through a lot of cycles. I was there through the Great Recession and everything and all that drama that went on during that time. And there was a lot of drama during that time. Come on in. But 20 years, a couple things you can know is that I know how to get the really hard, the really complex stuff done when it comes to creativity. Sometimes things don't fit in, they're not in a box. How's it going? Good. Welcome.
Thanks.
Even though this isn't my place, welcome. But yeah, sometimes you just kind of have to stop and think outside the box. And maybe if we have time, I'll share some of those creative ideas some of the ones I'm more proud of, I guess, over the years. But yeah, if you ever have some hard questions, things that seemed like they should make sense. Lynn called me yesterday with a scenario that made sense to her, but it's very out of the box. You're gonna have to go out of the box in order to make something grow out or work on that one. Anyway, so that's kind of what you get after 20 years of doing this. One of the things that we do love is 2-week closings. This class was almost about 2-week closings. Ironically, I actually get some pushback from that. A lot of people would contest that a 30-day close is better than a 2-week close. Their clients feel rushed and stuff. I'm here to tell you, I don't agree with that. And maybe we can talk about that sometime, but I have found the greatest referral source or generator is when the client has a 2-week close or faster. They are in love with that. It felt so easy, it felt so wonderful, even if they had to, go where and back during those 2 weeks, they still loved it because it was done so fast. And remember that possession and closing don't have to be the same day. That's the one thing to remember with 2-week closings, and it usually makes things a lot easier if the possession date's a week or so later. Sellers usually prefer that as well. So anyway, the 2-week closing, that's kind of our norm. So we've been closing loans at fast for probably 9 years, 10 years. And then last, I am a mortgage broker. So as a mortgage broker, I am able to shop around and check a whole bunch of different lenders all at once. There we go. I'm clicking buttons here. Maybe what we find though is as we shop around for clients, they of course are out there shopping around as well. We frequently are able to find a better deal and even the best deal. $5,000 isn't a random number, but kind of the minimum number that I've noticed.
What's your standard points that you charge?
So I actually structured all my loans with zero lender fees at all.
So on the back end.
Yeah, that's how we usually structure it. So if you know anything about mortgage brokers, we have a margin. It's a little bit more public than it would be with a normal mortgage or a mortgage banker or a regular bank. They don't have to disclose their margins at all. I was at Academy for 8 years. Well, actually, Republic Mortgage, who was acquired by Academy, I was at a company for 8 years. Awesome company, loved it. That's where I learned how to close my loans in 2 weeks and how to solve some of the most impossible stuff. Awesome, and they still do amazing stuff. But I can smoke them on price all day long. I had a lot of repeat clients coming back, having families coming back. I want to give them better deals, right? And so I went in the broker world. It is a lot harder to be as effective as I was there on my own. I have to control the appraisals better myself. I have to control the underwriting better. But we save a lot of people a lot of money, and we're able to smoke them on all the rest of the stuff. So anyway, so that's me. Didn't want to talk about all that too much. Just I wanted to get started there so you guys know who you're listening to. So this mortgage rate lockdown, I don't know if you guys have seen, anybody seen those headlines? Did somebody see a headline that says mortgage rate lockdown, that catchphrase? So it's an interesting one. I subscribe to Housing Wire and they talk about that a lot. They probably coined the phrase. But all that basically means is that people won't move, right? This header inventory will suffer as homeowners don't want to trade.
I mean, I've had at least 8 buyers interested and they all just fizzled out, freaked out.
Yep. Good. That's exactly what we're talking about.
Yeah.
And so interestingly enough, they have this crazy low rate and they because of it, they're missing out on a great opportunity. And we see these higher rates, everybody, we freak out too. It's like, oh my gosh, that's such a huge payment or whatever. But what did it do is it slowed the market down, right? It creates this downward trend. The amount of transactions we're doing, the prices, everything started coming down, right? And the interesting thing about a down market is when it's going down, everybody's afraid, right? The sellers are freaking out, there's less competition. And so it's actually a really great experience as a buyer, especially in contrast to 2021 and 2020. Anybody a buyer's agent during those 2 years? Was that an awesome experience for what? Oh man, I sat there and cried for my clients. But they got the 3% rates, so they're pretty happy about that, right? They can afford a house where today they couldn't. So there's some good from that, but it was hard. The problem is when we hit the bottom, of course, now the sellers aren't as afraid. There's more competition, and so helping our clients try to get into the market before it's fully rebounding. That's what this is all about. They have again these pesky interest rates we got to work with, and so I didn't know how to do that. I'm so proud of those little red arrows.
That's awesome.
Red arrows.
We know where to look. Yep.
That's right. So what I have up here is just a scenario. I see this scenario all the time. I don't know if you guys do. I don't know if you're into the habit of looking deeper into your clients before they go out and start selling and moving. But this is a real life scenario, right? Or an example of several. So they got a $200,000 mortgage, and in this one, I'm assuming a $450,000 purchase price or sell price, right? So this is a house. They have a 200 grand. I've obviously rounded all my numbers. But 2.75 rate, and that's what they're telling you about. That's what they're super excited about, and there's no way I'm gonna give up that 2.75. I've got, 6%. Josh is quoting me over here or whatever. They don't want to give it up, but what they're failing to mention is just on their house still is that HELOC, that $50,000 home equity line of credit they got sitting at 8.5, which, by the way, the Federal Reserve is still talking hiking. And all the economists are like, no way, they can't do it, they can't do it. Nope, they're still talking about it, they're probably hiking further. One of them just this morning said they want to add another 1% to the Fed fund rate. So that's going to take that 8.5 to a 9.5. So if they're feeling the pain today, maybe call them back in a couple more months. Because they might feel just enough to finally make this move. But when you look at that $50,000 HELOC at 8.5, their $50,000 student loan at 6.5, couple car loans for 80 grand at 5 and 5.5, then throw $20,000 of credit cards in there north of 12% and 18%. And I don't know if you guys have looked at credit card balances a lot lately, but they're not balances, but the interest rates. They follow the prime rate too, just like those HELOCs. So all those rates are up. So when you take and you blend those rates together, you're looking at a 5.1. Again, not crazy high, but it's a lot higher than 2.75. And that's what people cling to, is that 2.75. And so it's really important that you take a few minutes with clients and just help them kind of walk through. I recognize there's clients that don't have any debt. Fantastic for them. And if they've got a 2% rate, they may very well just stay there.
I saw an example of this, just an investment property I was going to look at because they were willing to do a seller finance, but they have like this 2% first loan with their HELOCs at like 9.5%. And still those payments together are more than what you could rent it for. And I was just like, oh, anything with that.
Yep, exactly.
And I even said, you might want to consider refinancing altogether, but they were just like.
So the
about it.
advantage to what we're talking about here today versus a refinance is cash out refinances. When you consolidate, they're limited to 80% loan to value ratio. Whereas these guys could sell, pay off all that stuff and put 5% down on the next house, 95%. So sometimes it's actually better that they move rather than do this cash out refi. Yeah. But I like the fact that you're thinking about that. That's really important, right? So blended rate 5.1. Just, and I know you guys don't have a calculator and I can't give you a calculator to go and plug all these numbers in, but you're welcome to text me or email me that snapshot right there, and I'll go ahead and give you the blended rate. I'll give you a printout there and you can take it to the client.
I'm sorry, I didn't catch on until just now that you're blending all those different interest rates into that.
Yeah.
I'm sorry.
No, that's exactly what I'm doing. Yep. So if you blend the rates all together, because that's what this is their debt, right? Not this. This isn't their debt. All that's their debt. Right, so what they're actually paying is 5%, a little over 5%. So I've sent you the slideshow. You guys are welcome to keep it, disperse it. I mean, it's not like it's trademarked or anything. So yeah, there's a couple good slides here you guys might want to hang on to. So let that sink in. How did I come up with it?
I'm trying to figure out how you came up with a blended rate of 5% with all those interest rates, or are you just talking about once you refinance it?
No, it's literally a calculator that I created that goes through and adds, this is this much loan amount, this rate. I can't give you the actual calculator, but you can text me any scenario you want and I'll run it for you.
Okay, sorry.
So, yeah.
Jeff is like, you're always one step behind.
Today.
So, there's one other thing that's really important to recognize when you blend rates together is also blending the payment. And so all these debts have a payment. So this is the other part that I really wanted to focus on. So if you look at this payment, you've got $1,150 is what they're thinking. When they talk to you, I'm going to sell my house, I'm going to give up this $1,150 house payment. The problem is that's not even all their house payment is, just like you said with that HELOC, right? And so they have another $350 a month that they pay to a HELOC. That's interest only, by the way. I don't know if you guys know this, but HELOCs aren't always interest only payments. Hercules Credit Union, for example, I had a HELOC through them for a while. Theirs is 1.25% of the outstanding balance. So for that balance, that'd be, I think, $750 a month or $650 or something like that. Right? Now, it's crazy. It's weird when you get, never mind. I'm not gonna go down the HELOC road for a second, but anyway, it's a thing, right? So they might be paying $500 or $600 or $700 a month there.
Yes.
Even though the interest rate is only 8.5 only. But if you take all the rest of these payments and you combine them all together, they're looking at $3,500 a month. That's their budget. Right? That's the thing that they're like, You know, they're not thinking about this.
To like
All
sell.
they're thinking about
Yeah,
is 1150 or maybe 1500. And then we're gonna show them how to get a $3,000 house payment. No wonder they're freaked out. But what about all these debts? What about, and so what if we sell your house and instead of putting all this money down, so this is a scenario where they're selling it for 450, pay the agent commissions, there's buyers, they're gonna pay the buyer's closing costs or some of them, seller's closing costs, and they pay off the first and the second, right? They walk away with 166. They're always thinking, this is a question I get all the time. Do I have to put all of that into the next house? Don't I pay taxes if I keep any of that separate? And of course, we know they don't, right? But why don't we actually use that to consolidate debt, just like you were saying, right? And so don't look at these two scenarios yet. I wasn't too so fancy that I could like cloud those out, but I thought about it. But if this is the scenario that they were looking at, so $550,000 price, not a whole lot bigger house, but it's 100 grand bigger, right? It's an extra bedroom, extra bathroom, something like that. They're looking at a $2,800 monthly payment if they put that 166,000 down. Just a conventional mortgage, 30% down, which there's no advantage to going from 20 to 30 other than smaller payment. But that's what they think they have to do, right? And so they go from $1,500 a month in their house payment to $2,800 a month.
But you're not paying the debts off in that.
Not in this scenario, but this is why they're not moving. This is the solution that you guys need to bring to them for the people that are carrying debts. This is the part that matters to them, is this is all they're seeing. So instead of doing that, what if we actually take, you only put 20 or 30,000 down, and you just got the random 5%, 30-year fixed conventional rate, or a FHA, right? The FHA rates are lower. Either way, their payment ends up being in the high, what, $4,000, $3,800, whatever. So again, they're paying $3,500 right now, if their HELOC is an interest only, right? But they're paying $3,500 now. That $400 or $500 is way easier for them to swallow. They are getting a bigger house. I am okay with paying a little more. I just can't pay $1,500 more, right? And then, like I said before, remember, not everybody's got extra debt. Some people have a whole lot more debt. Some people, their monthly payment's gonna go down when they do this. They're gonna buy a bigger house with a smaller house payment. How cool would that be? And so it's just important to just kind of walk people through, you know, all
Or
these.
their
different
interest
little-
rates go down because they, well, no, it's after the fact, never mind. I'm just trying to think, once they get rid of all their debts, but you've already got them that, and then they're taking the extra money, or they could pay it off before. I don't know if that matters, like if their debt to income is lower, it's all based on their credit score, they get it for the interest rate, right? Or they could
So
bring
the-
their rate down more.
Yeah, I just kind of randomly grabbed, you asked me earlier what my costs are and stuff like that.
Yeah.
So these three scenarios just have a 1% charge in there,
Mhm.
which honestly aren't necessarily reflective of the market. They're not crazy off of today's market. But I just kind of put that there so that there's, you know, closing costs and talk about seller credits and stuff like that. But this is actually where I'm gonna pause for a minute. So I wanted to make sure that we give you guys time to digest this, ask questions, throw out different scenarios. I tried to milk this and make this take the whole hour. I couldn't figure out how to do it. So this is the main thing I wanted to talk about. After this slide, there's two other things, or I guess three other things that we could talk about and let you guys kind of choose your own adventure. For anybody that remembers what that book is.
Well, I like that you're a broker that will seek out other lenders.
So yeah, go ahead and just look that, think about it, ask questions. I'll kind of go back to this slide for a second. You
I
guys
think
can kind
one of
look at
the
that.
most important things he said is it's different for everybody. Some payments might go down, some are gonna go up, it's gonna be different. It's their scenario. It's what they're dealing with and their debts. They might, you know, again, do a hybrid of some of this and pay off some of the debts and keep some of it. But then maybe they can accelerate later. So it's really a conversation starter and start the investigation and explore. That'll help get them to make a decision. If they are just thinking in their own head, house payment one, get rid of that, new house payment. That's where they're frozen. They're not taking action because they don't have enough information to adequately look at their whole picture.
Like we could take that and just do a green screen and talk about it. On social media, that's a good idea.
Yeah, you're welcome to it.
absolutely.
Yeah, it's like out of the box thinking with it. It's like, yeah, well, we got the lender and the real estate agent, but we're thinking about all sorts of different things. However, originally, when I started buying a house, it's like, okay, here's my payment, here's this. It's cut and dry, that's all it is. But the last house I ever bought, it was, hey, if you pay off your car, then you can't qualify for this and you actually get a better deal. And then I don't have the car payment, so I can't afford this now. Even better.
Yep.
So this is, and this is kind of what I was getting, is it's kind of like, hey, let's look at consolidating, paying it off, so you can afford something better. And it's still gonna be about the same.
Yep.
Or better, or maybe just a little bit more.
So it's amazing to me how many people this is an island,
Yeah,
right? Like they will not think about everything else. They only think about their house. It's completely separate from everything. And yet it's really not. I just showed you, right? You guys are actually paying 5.1% interest on 400 grand. It's not that they're paying, 5% on 200 grand or 150. No, they're paying 5.1 on 400 grand. They think they're paying 2.75. But people just, and it's a consumer pattern that we have here in the States, is that people just, they separate their finances, and their house is an island.
They don't. want
It's a
to-
necessary evil. I got this payment, when they're shopping for mortgages and stuff. But don't just think about this for sellers either. It's like, for sure, have these conversations with sellers. But remember your buyers too. I have a first-time home buyer right now. He's got, I don't remember, I think it's like 80 grand in his 401k or something like that. And he's going to use that for his down payment. We quote him his payments because he was super fortunate. Last week rates went up after he started shopping. And he comes in, his house payment was $300 a month higher than he was expecting. So he's like, oh crap, he's about to pull the plug on the whole deal, which I wouldn't blame him. Except, again, he's got 80 grand in his 401k. How about if we pay off that van, that $9,000 van, $550 payment you got? And it hadn't even thought about it. He's like,
Yeah.
I can do that? It's like, yeah.
Don't know what you don't know.
And so his agent calls up the seller and says, hey, we need to finagle some numbers or he's canceling. Anything you guys can do to help reduce that bottom line, so he doesn't just bring the extra 9 grand to closing. And so they threw in another $2,500 in seller pay closing costs. So for him, his out of pocket is only going to change by like 4 grand. Because his agent's giving up some, the seller's giving up some more.
Mhm.
And so these guys like, wait a second, my payments, what I was hoping to begin with, actually lower. And now I don't have my car payment. This is awesome. I don't even have to pay for half of it.
Now you know why you use professionals.
Exactly. So
Well, I
just
just think the average consumer understands how much that car payment is reducing their purchasing power on the house. I mean, that
Yeah.
$500 payment is 100 grand
Mhm.
in to keep the same outgo of debt service
Mhm.
in purchasing power. And they just don't, they don't know what they don't know because they're not in business, right? And most people need a guide. They need somebody to say, let's check this scenario, let's look at this scenario. Otherwise, they're just like going off of what they heard on social media, what their neighbor told them happened to them.
Mhm.
And so just that alone, the car payment and changing that could change whether they buy or not.
And I'm not a listing agent. I've never been in a listing presentation other than when I'm selling my own homes, right? As a listing, as a seller. So I don't know what it's like, but I'm assuming that if the listing presentation included, hey, let's take a look at your actual debts. And you start getting into this problem solving right out of the gate and showing this information. Would that set you apart from the other people that came and did listing presentations to them? 100%. So there, go ahead.
So on your credit card, is that just paying interest only, or is that principal too?
So
That looks kind of cheap for fancy principal.
good attention to that. So I just grabbed 2% of the balance. Most credit cards seem to cycle somewhere near that, but you've got a very good point. So 2% would be a 24% annual rate, right? This card right here, if they're only paying a 2% of the balance, that card is going to be there for a very long time. So in reality, their payment's probably higher, because back in 05 with the FACTA Act and a couple other things they processed at that time, your card has to be able to pay off, I think, within 7 years, is how they calculate those payments now. It used to be back in, I'm going to talk about this maybe, but when the credit boom was rolling out, I don't know if you remember this, but credit cards literally could pay for infinity, like there would be no final payday if you just paid the minimum payment. I remember having a Provident card, I think it was, and it was,
Now they have to do it over 7 years.
yeah. Yeah, so I think it's, that's not my business so much, but I just remember when it changed. My clients' payments went way higher and they were all freaking out. But it was interesting because I remember my own card, it was like a $20 payment on a $7,000 credit card or something like that. Yeah, and that
That's
was
why
the
you
minimum.
spend it. It's like, as long as it costs me $20.
Yeah, and so I'm paying down $240 a year. No, I'm not, because my interest is $700 a year. Right?
Yeah.
And so it just literally
Just keeps on building.
Well, the other problem with this, if you do have an emergency, you're screwed. You're maxed out all the way through. So if you do have to go get a new set of tires and put on a charge card, you probably can't get maxed out already.
right. Yeah, it's not a very great, and this is very real right now. I know you guys are seeing this, but I don't know if you recognize this. The last few years have really warped a lot of people's lifestyles, spendings, everything, right? It's just messed us up. In so many different ways, because we're so not used to it. But when 2020 ended, remember there was all the stimulus that we kept sending out during 2020?
Making people.
And there's national statistics that watch the spending, the retail spending and stuff like that with those stimulus. It's pretty interesting. One of the things that they've been watching is the actual consumer debt has grown by massive amounts just in the last year. And so we may not even know that so many people are slammed like this on their debts. You might start this listing presentation, hey, let's take a look at this. And you might say, you gotta keep your jaw closed while they're telling you, and don't be shocked because that'll embarrass them. Right? But they're gonna have a lot more debt than you think. So yeah, these are really great comments and questions. What else?
I was just gonna make a comment on the listing presentation. I think if you go a little bit slower on the listing presentation and go here, but not necessarily do what the lenders should be doing. I don't think I would go into everybody's finances and stuff like that, but rather give them a scenario like this, like you said, screenshot this.
Yeah.
Well, here's a scenario. You might have something going similar. What we want to do before we decide what you're going to do with your house and your purchase is hook you up with somebody like Josh so that you can dive into that, because that'll help direct us on what our plan of action is. I mean, you guys know that a lot of times I talk about going on listing presentations and talking people out of selling their home. If it's not right for them, if I pose a solution to them or an option they hadn't thought of, this is the same thing. It's like, did you know this? Just those are questions. But I don't know that I would sit down and say, let's go through your finances, especially if you're just meeting them for the first time. But you get to defer authority to the lender, to the finance guy and say, that's not my area. I market and sell your property for top dollar and I'm gonna get you the most equity out of it you can. So I need to hook you up with somebody else before we actually set this in motion. I think that'd be a great conversation.
Love it.
Yeah. I like trying to, I take your advice on trying to talk people out of selling their homes. I think it just builds trust.
It does. It does.
Nobody's taking me up on it, like, hey, you should rent this house, it's a great location.
But you know what? You do
It's a
get credit
conversation.
for pointing out their options, right? There's, most people are selling.
This is one of those points.
It really is. It's,
You can have a conversation and talk about, their concerns about it and bring this up. I think it's a great idea. Have you ever thought out of the box? You have all these other debts. It's great.
anybody on Zoom have any comments or questions?
Well, that I can see.
Those people that want to make the drive.
Yeah, I didn't know you guys knew Jennifer.
Neither did Debbie.
So, a good friend of mine, we know each other a long time.
I think this just adds to the whole fact that you can do other things like buy plates down, seller contributions, all that, which just kind of adds to the strength of how you're helping them.
Well, you bringing it up is a good conversation starter because they're thinking,
Yeah.
that's why, this is a big contributor to why our inventory is so low. We don't have the resale houses we used to have, and new construction can't keep up. They can't build houses fast enough to supply us with enough homes for the buyers that are in the market. Because like you started with, this is sitting there. There's people that want to move and they feel stuck, like you're
This is like, or I use your tactic too of going in and just like I already have the listing.
Mhm.
And it's, I bring up the let's come up with a plan for you, you know, let's start thinking like outside the box, adding this in there. Like, here's a couple of scenarios going forward, what's your end goal?
Yeah.
Like, what are you planning to do?
I like that you do that. You go in there with confidence as if you know, they should be using, you know? And so now it's just like, because people need a guide, they need somebody to say, okay, this is what's gonna happen next, this is what it's gonna look like moving forward. That's what they want and they need. They've maybe done this once or twice in their life.
Very good.
I wish they would do it a lot more in their life.
I just figured out how I can figure out that blended rate.
His calculator.
Is it a
Yeah.
mortgage calculator? Cause I did ones for.
I have no ability to provide that blended rate calculator. It's
That's
a
what's
website.
actually.
But
Yeah,
yeah, so
got
that one thing I can't give you, anything else, it's not hard to do. This is something you definitely can do, right? If you want to, you can get in and figure out what all their payments are. We can definitely run some mortgage payments and compare the two together.
I probably can't do it on my own. No, I think.
The blended rate is, I mean, it's not complicated math, it's just complicated to track what you've got going on. So it takes a minute. Any other questions on any of this? Okay, so the rest of the time, I have 3 different topics. You guys can choose your own adventure. As you said earlier. So what matters most to you? So that's the question that you guys want to answer with this. Do you guys want to go through different loan scenarios and some of the creative financing that's out there now? Do you want to talk about the future of housing? I know you guys have your own opinions of that as well. What's going on with house prices, or do you guys want to talk about interest rates and where they're headed?
I should option B.
So future house prices, what did you say? Interest rates, see,
So we're gonna talk about all of it now.
we might. Okay, ladies first.
Yeah.
So by virtue of my slide, we should do this first.
Well, then do this. He's the lady, okay.
I guess.
He
It's
is the
2023, who knows?
Baby.
Yes, all right, I'm gonna do that just because of the order of the slides, so. Okay, so house prices, 20 years of doing this, it gives you some really interesting perspective on house prices. What you're looking at is just the generation sizes. It's one of many different graphs out there. They all have different numbers on them, but the general consensus is the same. The baby boomer was the biggest generation. Gen X was a much smaller generation. On the graph, it doesn't look much smaller, but 10 million people is a lot. That is a lot smaller, right? And then millennials are actually even bigger than the baby boomers as they've come out. And the millennials are actually, in some charts, are a lot bigger. They're 3-4 million people.
Second generation.
Yeah, so these, I'm not gonna talk about them at all, but this right here is the whole reason house prices have been going up. This combined with new construction. But there's a little history that I feel like is really interesting. I mean, I share with you guys, and everybody, every time I share with somebody, they usually give me like, oh, wow, that's cool. So I'm gonna assume that you guys are gonna feel that same way and not be bored by history. But if you guys go back to where baby boomers were raging, that's back in the 90s. And I know Ashley's not gonna remember the 90s very well. But I do know that in the 90s, that was one of the greatest economies the US had ever known up to that point. Everybody was giving Bill Clinton all the credit for having just this awesome economy. Our national debt was actually neutral to declining during that era. So that actually was pretty awesome. And that's definitely on some of his shoulders. You guys are gonna think I have, certain leniencies here on political stuff after I'm done with this.
You're just pointing out
history.
facts, okay?
That's, yeah, so he got a lot of credit for that, but at that time, the reason why is because this is the biggest generation our country had ever seen in their prime income creating and spending years. And they were there through the 90s. The impact that had, though, was that when the Gen Xers started stepping up, a much smaller generation, therefore they're gonna spend less, they're gonna live in less homes, everything's just gonna be less. When that started kind of taking center stage, the banks didn't like it. The banks were like, no, we want our money back here. We want some more money. This is awesome. Home prices have been climbing. We want that to continue. So they started rolling out something called the credit boom. And the credit boom was where they start rolling out all these different types of loans, like the credit cards that we were talking about, right? They just roll out all these different financing options to allow people to spend more money without having to actually pay for it. And so early 2000s, they revamped the bankruptcy laws.
Oh, remember that?
Well, the bankruptcy laws at that time allowed a lot of, like, you could just total wipe out every 7
That's
years.
what you're talking about. Okay.
They redid those laws around just before the Great Recession, so that a lot of people have to do 13s now. because they actually make good money. You could make $500,000 a year back in the early 2000s, and if you needed a bankruptcy,
Yeah,
you're done. Yeah, and so people would just do that. They'd spend. Oh, I can't
because
handle
they
that.
created a monster.
So the credit boom also came into mortgages, right? We started giving people mortgages that didn't, number one, they didn't deserve them. But some of my favorite ones, I remember the moment that I took a closed loan, like the HUD loan to file, I took it to my accounting department, and I said to my friend who I was walking with, there is no way in heck I would have ever given this dude a loan. I don't know what the crap the bank was thinking.
Mhm.
And that should have been a red flag to me. I did not see it coming. But I remember thinking that thought. And yeah, we were given 100% financing on a 4-plex, interest only payments. And we financed their closing costs, and they could have had a bankruptcy the month before. They could have had a 550 credit score. It honestly didn't matter. That's the financing. There was no rules. If you had a heartbeat, you could get a loan. And even half of that time it was broke. It was fraud stuff going on everywhere. It was nuts. But that credit boom, what it did is it enabled the Gen Xers for a while to maintain the same spending patterns that baby boomers had. And so in housing continued to climb. They climbed very rapidly in the early 2000s, not like the last couple of years, but still very rapidly, especially given that people weren't occupying that space. And then what happens is it finally started catching up. I finally have so many $20 Provident card payments and all these other payments adding up that I can't handle it. And so, now I can't make my payments. I start missing a few house payments here and there because I have 4 houses, right? And, people that shouldn't have 1 house, they have 4, and they're struggling with those payments. And so what do? They stop making those payments. And now the house that's been built starts to crumble very, very quickly. And so 2008 was generated 90% because the baby boomers small, or the Gen Xers are small compared to the baby boomers, and 2, that credit boom just like amplified whatever they were doing. But everything comes crashing down, 08, 09, right? Everything comes crashing down, and the construction market brought almost to a complete halt. The number of homes per year, somewhere between 1 and 2 million a year, is what the national progress is like these days, and should have been. We've never built 2 million homes a year as a country, but it granted to less than 100,000 homes a year, right? In the whole country, we're being built. So just the construction industry it was rooted with that, right? So then 2011 comes around, 2012, and these guys start getting old enough to want homes, and they watched all these other people that just went through this financial order, and they're like, well, I'm not going to be stupid like them. And I know millennials have taken a lot of crap in the news, a lot of bad, like, name calling or whatever. I'm here to tell you, I've never had better clients than these. Like, they come to me with 750 credit scores, 100 grand in the bank. It's ridiculous how often they're way over prepared for their pre-approval. So I've been really impressed with them. That's because a lot of them have waited. The median age of the millennial and home buying on that process, where the most people should be buying their first house as millennials, was 2020. But to this day, they still haven't. We still haven't crossed that threshold where the majority of millennials. It's kind of interesting, because that means that we still have a whole lot of millennials coming, still buying their first homes. They're in this problem that they have with this. So why am I talking generations and stuff? You're going to see this now. So household formations is a statistic that comes out every single month. It's pretty fascinating, kind of, for me. It is. Yeah, so household formations is anytime somebody leaves their parents' house and creates 2 households where there was 1, or a divorced couple gets divorced and there's 2 households created from 1. So anytime there's a new household created, right? So this is where it's really interesting. You can see that right here, it's a 0. That's your 0 line, right? And so there is moments where negative households are created, like COVID and stuff like that has an impact on that. High interest rates, like we just had an impact on that, where people are like, well, I'm not moving out. I just got married, but I'm not moving out, right? Moving in with mom and dad. Low interest rates in 2020, interestingly enough, actually kind of spiked all that. We got up to 5 million households created in that little short time span there. Last year, we averaged somewhere closer to 1.7. The time that I created this little graph, though, it was 1.4. And then this guy is our 20-year average. So it's still over 1 million households a year. So if we're forming 1 million households a year, then we need 1 million new houses to house them, right?
Mhm.
And when these surveys come out, by the way, that talk about housing, new houses formed, housing starts, for example, they're talking about everything, including apartment buildings. If there's a 100-unit apartment building that's built, that's 100 units in this number. So 1.7 million at the time that I created this slide, it's not this whole presentation, but this slide of the presentation, it was 1.7 was housing starts. I'm going to skip over that because don't pay attention to housing starts. It's not what's important. What matters is the housing starts that are completed. So at the time I did this, there were 1.3 million. What people forget to pay attention to is that there is housing destruction, right? Homes get old, they get flooded, they get burned. I mean, just 100,000 homes a year, we lose them. So total new supply at the time of this is 1.2 million, but household formations were 1.4 million. So you see that shortage right there? Now you do that for 4 or 5 years in a row, you have a big problem. And that's what we've been seeing. Our inventory has been declining little by little by little. Starting to take a picture that goes past. You got it?
Yeah.
Say cheese.
My phone is smoking today.
I'm gonna skip this slide. This is 2012, so from 11 to 13, this is how the housing market prices went down. You can see the rebound was pretty significant compared to that same decline. But that wasn't really what I wanted to focus on. Oh, this is actually. So 8% growth, locally it was a 20% rebound. And I think we had,
Here in Utah.
yeah, I think we had 20,000 listings in Utah, or 19,000 listings at that time, which is kind of important to remember in today's world. This little chart is what I wanted to show you. So sorry I didn't add all the labels, but this is 2007. This is 4 million existing homes listed. Okay. I don't remember how good that's 2000. I don't remember. But right there, you can see 2012. So this moment right here, there's 2.5 million homes listed. At 2.5 million nationally listed, we had an 8% rebound in prices with 2.5 million listed. Now, from this moment to this moment, there are almost 20 million new homes built in the country. So we went from, I think it was 112 million up to 130 million or something like that. That's how many homes are actually in existence in the United States right now. So we have less than 1 million homes for sale, with 20 million more homes than we used to have. And we had an 8% shot up back then with 2.5 million. So this is all because the household creation is outpacing the housing creation. Does that make sense? So the future of housing, house prices, where's it going? Well, it has everything to do with the generations. I'm gonna skip that one. And as long as that imbalance remains, and we got to see a perfect example of what happens when demand wanes. What
So
do the
yeah,
builders do?
convince millennials to buy.
Well, millennials, and I'll talk about Gen Xers in a second, but what happened to the builders last year? Did they ramp up building? Did they stay the same at what they were building? What did they do last year when rates went up? I'm testing you guys, making you think, waking you back up.
Well, we got
I feel like they've had to
choice.
hold on to a lot of their
State.
inventory and then drop their prices.
Yeah, the state was not-
What do you think? What do you think happens starts? That housing starts drop. Yeah. What about their completions?
Same things.
Oh, yeah.
Yeah, they're like contractors, go home. We don't want that house finished yet.
Yep.
And we don't want to spend another dollar on it until we get the existing inventory sold. So household formation slowed down a little bit. Mainly because the prices went through the roof. Builders went, oh, we're not building anything more. And so they've got a tight hold. Just from their business plans, they remember 15 years ago way too well. They do not want to flood the market. And so as long as they go nice and easy, we keep it nice, healthy, easy to sell the house market. That's what they want. That's what they got to do. So until that imbalance reverses, and we've got probably an easy 3 to 4 or 5 more years of this kind of healthy imbalance from millennials. It'll still take them probably 10 years to get the majority of them by. But we still have 3, 4, 5 more years of solid, like crazy strong demand from these guys. And then these guys are turning around and flipping the tables. They're early adopters. I've seen a couple reports of as many as 30% of 25-year-olds own a home already. Kudos to Gen Z,
Yeah.
but that means they're pulling it forward. If they're gonna early adopt and combining at the same time, these guys are still such a huge generation. So.
Yeah, I mean, but I've got kids that age and they're like, we can't even afford a house based on the incomes.
But since they don't really want to get married all that bad, I want to just buy them and buy a house together.
Yeah, no kids,
Party.
the marriage.
Yeah.
And then if they got in the market, you know, a couple years ago with interest rates. No brainer.
So I share this
You
with
got one on the
everybody.
edge, you got 100 grand.
Sorry.
Sorry.
Yeah. No, go ahead.
I've had a few clients that are. Parents have just gifted them, you know, huge amounts of cash.
Yeah, any clients that you have, buyers that don't have a down payment. So more than likely their parents want to help them. But their parents haven't thought it through, like, oh, I got 200 grand equity sitting in my house. I'm not kidding, like, it just hasn't clicked. So don't feel like you're treading on ground you're not welcome on. Like, ask them, have you talked to your parents? No, I won't cry, you know, I don't want to buy, you know, whatever. Ask your parents, you know, just talk to your parents, because you can pay them back, right? But ask your parents. Your parents probably will say, yes, we want to, but we can't. Because the parents have a whole bunch more debt, right? They also need to sell and consolidate. But the parents are forgetting the fact that they have 200 grand, they can access that for their kids. So yeah, definitely make sure that's on the table. Anytime somebody asks me about the future of home prices, this is what's been controlling that answer for a decade. This is what controlled the answer before the Great Recession, right? So this is like the major trend. There are all kinds of other things that can influence it, but that's the main trend right there. So make sure that you're clear on it. Any other questions or thoughts on any of that? Okay, so should we go into rates? Okay. So rates have essentially three parts to them, three things that you want to watch. So how are you doing? Okay. So inflation, that's the front lines. Everything that inflation does, rates should do. I want to spend most of what I'm about to say on what the Federal Reserve is doing. I think that what they've done has the biggest impact on everything right now. But inflation, I know you guys probably have seen some of the reports. So there's 4 reports that come out every month. And every report has 2 reports within it. It has the headline number, which is all inclusive. And then they have a core number, and that core number will strip out food and energy. And the food and energy, because they're so volatile, it's kind of hard for anybody to control.
Reports.
So the CPI is one of them, the Consumer Price Index. They have the PPI, the Producers Price Index. You have the PCE, which is the Personal Consumption Expenditures Index, which is the Federal Reserve's favorite. And then you also have the employment report that comes out. The non-farms payroll includes the wage-based inflation. And so those 4 reports are the reports that make inflation news. And every month they come out. So it's really confusing to track them because all 4 have their numbers every month, and they compare to other numbers of their own.
Okay.
And then they have 4 readings. So there's 8 numbers essentially every month. So who the crap are going to keep these numbers straight in their head? Right?
You,
Nope. Sorry. But generally, so back last fall, we made it to where the CPI number was almost 10%. It was 9.98, something like that. And so that's what we all felt. Like we all felt that, remember? And everybody's, even my kids are saying inflation and stuff like that. And they're like, oh yeah, it costs way more now. I love inflation. It doesn't even know what inflation is. Right? And they're using the word. So it's kind of funny.
Just knows of something they buy costs more now.
Yeah, which is all it really is.
Yeah.
But when inflation goes up, rates will always go up. When inflation goes down, rates will fall. When is the question, right? When is the question? Right now, we're still sitting somewhere in the high 4s to the low 5s, depending on which report you want to look at. The CPI and PCE, those are probably 2 heaviest weighted, and those 2 are sitting. You know, the CPI came out. Today's Wednesday, right? Yesterday. Yeah, CPI came out. No, excuse me. My days, but I don't do yesterday very well. If you guys ever want to know me a little bit about yesterday.
I'll let you invest.
Yeah, that does it too. Anyway, the last CPI came out a little high. So I think it came out last Tuesday. And I was now I'm on film saying that I can't remember. Assuming. Anyway, so CPI and PCE though, and those 2 are both ranging between 5.5 and 4.75, depending on which one you look at. And so, anyway, inflation is not the number 1 on our rates today, though. There's something else that's bigger. So jobs is another one. Jobs is the smallest, and so I'm just going to breeze over this one. But the better jobs are, the worse rates are. The worse jobs are, the better rates are. So if you hear a whole bunch of horrible news about people losing their jobs, call me and we'll refinance because rates are going down. Right? It's almost perfect, so. But interestingly enough, the jobs are very resilient right now. The Federal Reserve and every economist I know has been expecting the jobs to get worse for like 2 years now. And they keep staying pretty dang good, okay? So let's talk Federal Reserve. This is another history lesson. Federal Reserve, let's almost want to go back to the generational thing. So in 2008, when everything started crashing, the news kind of started hitting and everybody started freaking out. So I don't know if you remember 2008. This really geeks me out, so I'll try to hold back the reins a little. So in summer of 2008, ABC Mortgage, which nobody ever heard of them, but they were a monster. They went out of business. Well, they had $800 million of loans that were closed, signed, that hadn't funded yet. And then they closed their doors. They didn't open, no warning. They just didn't open their doors next morning. $800 million of people that just, they're like, we can't.
People that should have been approved for loans.
And so they went to the closing table already. They already signed. And they never got the keys because the funding never made it. So they all had to start all over. That was July of 2008. August of 2008, Lehman Brothers Bank. You guys remember Enron? Remember hearing that?
Yes.
Enron made huge news, not just for the scandal, but because it was the biggest bankruptcy in American history at that point. It was $6 billion. So when Lehman Brothers filed bankruptcy, it was a $600 billion bankruptcy.
Oh, no.
Yeah, and so that one was massive, followed right behind Washington Mutual. So you guys remember that name?
Yes.
Washington Mutual was acquired. They had $323 billion in cash deposits, right? When they were acquired by Chase Bank for $9 billion. So try to wrap your mind around how that worked. But they got shut down by the FDIC because their leverage ratio, their amount of loans versus the dollar value that they had was over 34 to 1. The normal banking sector, still shocking, is between 10 and 15.
Yeah.
So for every dollar of yours they have, they'll lend $10 to $15 of loans. That's how the banking world works. That's why banking crises are so dangerous. Right? Anyway, but 34 to 1 and they went out. Lehman Brothers is the same. That was on the, so the Federal Reserve's like, oh crap. The world was getting really ugly, really fast. I don't know how much you remember about all that, but in December.
They're done,
They're gone.
right?
Yeah, it's just like this SVB that just went out, Silicon Valley Bank. So the 3 banks that went out this year are actually 3 of the largest bank failures that we've had since Lehman Brothers. That's a great question. So Silicon Valley Bank and the other 2 names, I have to look them up. I don't remember. Very significant stuff that happened this year. It's been hugely downplayed. All the media, I'm pretty confident the Federal Reserve's called the media outlets and said, if you guys want to live, you will not talk bad about
Because
this.
everyone will start pulling all the money and
It's
start
literally
burying things underground.
Yeah, because those are massive banks. They had a massive amount of money. And they just let it go. Anyway, so December 2008, Federal Reserve sees all this and they're like, hey, we're going to come out and we're going to buy $600 billion of bonds. You know, treasury bonds, mortgage bonds. And that's called quantitative easing 1, round 1. At that time, just quantitative easing or QE. So these are quantitative easing. I don't know if you remember these phrases.
I've never heard of that. This is interesting.
Cool. So QE1 starts out $600 billion, had the effect that they were hoping for. It immediately brought interest rates down because the Federal Reserve just announced a $600 billion appetite for mortgage bonds. So everybody that owns mortgage bonds like, hey, I can jack up the price. When I jack up the price, that brings interest rates down. And so interest rates started going down at that point, which created a lot of people wanting to buy homes who didn't really care about all this crisis thing that's going on, right? So it kind of stimulated the housing market a little bit, which was good. They found out they needed to stimulate it a lot more, so they increased from 600 billion to $1 trillion. That was quantitative easing round 1. A couple of years later, they're like, yeah, we need to do it again. So quantitative easing round 2, QE2. And then again, after that, they're like, yeah, we're going to do it again, but this time we're not going to put a limit on it. We're just going to do whatever we need to do. And so that became QE infinity. Now, to clarify, that Federal Reserve is not the US government.
Yeah.
A lot of people get these two confused. They're too completely. The Federal Reserve is not a bank where they're taking money out of their pocket. When they create money, that's what they're doing, is they're printing. So they ran the printing press, $600 billion, $1 trillion, another $1 trillion, and then they use it, they go buy stuff out of the economy, the bonds, and that's how they injected, $2 trillion into the US economy. Okay, so they're putting more money in people's hands so that we're more apt to spend and less apt to save. And that kind of stimulates the economy in general, while they're buying bonds, which stimulates housing. And so it was actually a pretty impressive effort. I was a huge fan actually of what they were doing. But QE3 rolls out, QE Infinity. When QE Infinity finally reached its climax, it was probably a little over $4 trillion that they had actually purchased or injected into income. That was 2017, 2018. They're like, okay, the economy's doing pretty good. We're gonna go ahead and start letting some of this roll off. Late 2019, nothing to do with COVID yet, but some of the economic indicators were not looking so great. So then they're like, we're gonna start buying treasuries again. We want to give some confidence to the markets. So they still have $4 trillion of things, bonds and stuff, but they said, we're gonna go start buying some more. And then of course, 2020 hits, COVID hits, and then the federal government, this is where the federal government comes in. They're like, hey, homeowners, we know that you guys have to go home, you have to isolate. So we know you can't make your money, so you don't have to make your house payments. You guys remember that?
Oh, yeah.
Yeah, I'm like, what about-
When I heard that, I
Yeah,
think I made a YouTube video at like midnight that night and sent it out on my client base, like, be in touch because we're about to do a refi boom. It's gonna be crazy, but yeah, there's gonna be low rates coming. And so the Federal Reserve at that point, they come out and they're like, whoa, so this is bad. So the way it works is Fannie Mae, Freddie Mac, FHA, all these guys, they demand payments from the banks. So that, like, we're talking $12 trillion, right, that these guys have in mortgages. So when the federal government says you don't have to make the payments, the banks aren't receiving any income, but
They
they have to
still
keep
make
paying
payments.
these 5 entities, these 5 agencies. So they quickly made some adjustments. So these guys started cutting the banks a little bit of slack, but for a few days, it didn't look like they were going to do that. And so there was another banking crisis created. And that's where the Federal Reserve came in. They started buying $200 to $300 billion of bonds a month. So for 21 months, the Federal Reserve purchased,
printing more money.
yep, they purchased over $4 trillion more in a 21-month span, what they had done previously in 9 years. They did it in 21 months. And so today, the Fed's balance sheet is 8.3 trillion. And this is why I bring it up. So now you kind of know the history of what they've been going on, what they've been doing. So they don't want their balance sheet that big because it's inflationary. They injected $9 trillion into the economy. When I hand everybody in this room $1,000,
Mhm.
right? We're all gonna be like, sure, let's go have a good time and spend it, right? If everybody in the whole state received $1,000 stimulus from Utah, Utah State, we're gonna have more inflation because everybody wants that item. What's $1,000? Sure, I just got it for free, And so that's a very inflationary thing. So the Fed's like, we gotta pull that money back out of the market. And so this is the one thing that you don't hear in the news. They haven't been talking about this one step, but they had a $9 trillion balance sheet. They have an $8.3 trillion balance sheet today. That means they sold 700 billion in the last year.
Yeah.
Well, they just they own treasuries, and so they just go into the treasury market, they own mortgages, and they go to the mortgage market, hey, you guys want some? Or there's also a natural runoff where I have a mortgage and I sell my house and I pay off my mortgage. Well, the Federal Reserve owns that treasury or that mortgage, right? So I just pay them off. So right, so they don't have the money, they receive it, they destroy it. That makes sense?
They destroy it.
Because they print it, they destroy it. If they don't want it in the economy.
Okay.
Yeah, they destroy US dollar.
That is so interesting. This is really interesting.
Well, that's why I thought I'd go through it, but understand that whatever the Federal Reserve does with their balance sheet, or whatever the Federal Reserve wants to do right now, they're saying, don't fight the Fed. They said they want jobs to weaken, they want people losing their jobs. They've actually said that in the last 7 months, right? They said that they want no inflation, they want to reduce it way down, right? And so don't fight the Fed, that's what they're planning on doing. So even though inflation is way better, we're still sitting, high 4s, 5%. And so the Feds are like, nah, we're going to keep dropping. And they're taking a ton of heat from a bunch of people, but the jobs have remained pretty dang resilient. So I don't know, it's kind of hard to say, but they have quietly been selling their bonds. So they sold 300 billion in January, February this year, prior to the bank failure. Once the bank failure came out and the crisis
They
began.
sell the bonds and then that money they get, they just destroy it.
Yep.
So wasn't it because the banks bought bonds cheap and then inflation hit and so now the banks are losing money?
So that's exacerbating the crisis.
Right.
Yeah.
Yeah.
So that's like, you're like 2 levels deeper than the media is probably permitted to talk about, right?
Oh.
But yeah, that has everything to do with why the banks are struggling so much, is because they're
Right.
having to create liquidity. In order to do that, they have to take these little tiny, these really low rate things they have and sell them, and nobody wants them, so
Yeah,
they have to
they-
take a major
They
hit.
can't sell them, and then people are pulling money out of the bank. And then cause a 2-tier effect.
Yep, it's been a big deal. So that, along with the, this debt ceiling talk that we've had going on the last couple of weeks, has got a lot to do with why rates actually went gone up. Because May 10th was supposed to come, May 10th was supposed to bring lower interest rates, because inflation is gonna come out, and it's gonna be a good report. But May 10th came, rates got better for a moment. And then we went right back up, and we hit 7% last week.
Oh, geez.
Yeah, so where are rates heading? I'm not answering that question. All the
That's
economists
a
are
par
saying,
rate, 7% par rate. I mean, I know you get paid on the back and that's
Yeah.
probably, wow.
yep, that's exactly right. So to answer the question, where are rates heading? My opinion, so you don't know, right? You just gotta watch these 3 indicators the most. That's the only way you can know.
CPI, PCE and,
Just inflation in general, which direction is it going?
Okay.
Jobs in general, which direction are they going, and the Fed balance sheet. But if you watch those, you'll have a pretty good idea of where rates are heading. All the economists unanimously are saying that rates are gonna go down this year. So they were saying that from 6.5, they should go down to 5.5. So they're still thinking by the end of the year that we'll have, 1% lower rates. But honestly, most economists have been saying that since last fall, when they were at 7%, and we're right back. January here and last October, we were at 7%, north of 7. So I mean, I don't know, I don't see them going down at the moment. So
Let's make sure the jobs are being stable.
yeah. So I don't know exactly, but I was gonna talk about inflation here, but like I said, I kind of changed my mind. I want to talk about the Federal Reserve. Any other slides you guys want me to go back to? Any other questions, deeper questions about rates or house prices or anything like that? Looks like we're at time. Oh, I made it. I'm actually really proud of myself.
You did awesome.
So I really didn't get that.
That was amazing. That was amazing, Tom, Josh.
Well, hi. That's
Hi, that was amazing.
really was listening on the computer. So, yeah, there's your blended rate calculator slide again, with the payments. And then, yeah, so you guys are welcome to use all the slides. However you want, but yeah, just remember, if you guys have any questions, I've been doing this 20 years, try and stump me. It's a little bit more fun. 2-week closings, if you want to get that, but that's your normal. You'll close twice as much business. And you won't work any harder, it'll be the same amount of work, honestly.
Screenshot that contact slide, guys, on Zoom. I'll post these slides in our Facebook group as well.
Just going cheap.
okay,
My margin seriously is really low.
that's awesome.
Yeah, I've
And
My
you don't
margins-
stick in a box like you'll find other ones.
Yeah.
It's like I've worked.
You guys
other
didn't
ones
choose
where I
to talk about
found them other
loan
ones.
stresses. So yeah, I can't answer that. But yeah, no, we look for options to whatever the client needs. I'll give you this one just as an example. I had a guy who had a house who was zoned, it was a twin home, so it's 2 separate houses, right? But it was zoned as a condo. So it's one little parcel. It looked like a duplex from the street, but it's a twin home. And he calls me and he's like, hey, this house is zoned as a condo, but there's no HOA because it's a 2-house HOA, right?
Yeah.
And therefore it's non-conforming, so I can't get him any of the 5 agency loans. And I'm like, dude, you don't want to, and he wanted to refinance. I'm like, you don't need a refinance, you need to fix your zoning. And he goes, I can't because the owner next door, we each have, I got a mortgage with city mortgage, and trying to get anybody to do any of that is impossible. He's got his own mortgage, and so that's impossible. And we have to have all these different people sign off on stuff that can't even comprehend what we're doing.
Always someone.
And so, yeah, so I thought, well, I'm gonna do a construction. And so we did a construction loan, paid off their mortgages. Right, both of them, so that, and we just did a local company, right, that has a construction loan, so we were dealing with a person. Right, they signed off on everything for both borrowers. They go and rezone it, get all their milers and everything else, the utilities, everything signed. They come back, and now we have 2 separate homes. So we subdivided.
Construction was so that company would come.
Yeah, there was no construction. We
Yeah,
just used a small little construction loan for it. So the rate while we were doing that was like 5.5 or 6. So it wasn't crazy. And then, yeah, once it was done, we gave them both awesome financing. So, yeah. So you gotta think outside the box a little bit sometimes. But good.
Super cool. Anybody on Zoom got any last questions, thoughts? We'll cut you loose. See you, Debbie. All right, thanks, guys. Good job, Doug.